We are diving into a comprehensive financial analysis report today, focusing on the EV manufacturer NIO Inc.
Yes, this one is titled NIO Stock Alert, Why $5 is the Ultimate Buy Zone.
And it presents a highly bullish case that the current $5 level represents the ultimate accumulation zone.
It does. And that objective is crystal clear. The analysis does an excellent job with the quantitative data. The delivery volumes, the margin expansion, the cash reserves. It's all there to support that $5 thesis.
But I sense a but coming.
Well, when you build a case this confident, you have to intentionally try to break it. That kind of stress testing is what separates a strong argument from an undeniable one.
Right. So let's see how we can make this thesis truly bulletproof. And that idea of robustness, I think that leads directly into our first key area for feedback.
It does. So the analysis makes an exceptionally compelling bullish case, but it could significantly increase its analytical robustness and, maybe more importantly, its credibility by integrating a detailed look at the key counterarguments and the defined risks that are still out there.
Right now, it feels almost exclusively focused on the positive data. We see the fantastic Q3 deliveries, that impressive gross margin jump to 13.9%.
Which is a huge turnaround.
A huge turnaround. And the substantial $5.9 billion in cash. The bearish side is barely an afterthought, sort of dismissed with a quick line about how the bears are shouting sell.
Exactly. And for a high-stakes financial report, that absence of clearly defined risks, it just weakens the whole thing. A sophisticated reader could easily think the thesis hasn't been properly stress-tested against what could go wrong.
Against events that could push the stock below that $5 floor.
That's the key difference, right? Naive conviction versus informed conviction. If you don't acknowledge the risk, the person reading this just assumes you haven't seen it, and that breaks trust.
So the suggestion here is pretty straightforward.
Yeah, integrate a dedicated objective section. Call it Key Risks and Mitigation, or something similar. It shows intellectual honesty. It shows you've proactively looked at the headwinds and that the $5 price point is a genuine opportunity despite those challenges, not because everything is perfect.
It's about signaling you've looked around the corner. And we can use the figures already in the report to build this out, right?
Absolutely. Take the Q4 guidance, for instance. The analysis projects a really robust 120 to 125,000 units.
Yeah.
A strong risk section would need to analyze how that could be impacted by external factors, supply chain issues, rising battery costs, anything. And then, crucially, define the financial impact.
It's not enough to just say if guidance is missed.
No.
The analysis needs to quantify that downside. So if they miss guidance by, say, 10,000 units, what does that do to that 13.9% gross margin? Does it drop back into the single digits?
That's the question. Quantifying that helps the reader understand the actual volatility they're dealing with. And I also noticed the report leans really heavily on the future success of the sub-brands, Envo and Firefly.
Right. It calls Firefly the brand that will open up massive mass-market revenue streams. That's a huge assumption.
It's a cornerstone of the whole growth narrative, and that is a perfect scenario for a risk assessment. Firefly is targeting a segment NIO has never played in.
We need details on dilution risks or, more critically, the competition. You have established global players and domestic giants like BYD who are already fighting fiercely in that budget EV space.
The report just assumes success. It needs to address how a premium brand like NIO will execute that kind of down-market shift and somehow protect its margins at the same time.
It needs to be treated as a capital expenditure risk, not a guarantee.
Exactly. If they spend a ton to launch Firefly and it just struggles to stand out in a crowded field, that changes the investment case completely.
And speaking of capital, let's go back to that $5.9 billion in cash. It's presented as this massive safety net.
And it is a massive positive, but context is everything, especially for a company in high-growth, high-spend mode.
So the analysis should contextualize it by estimating the cash burn rate.
Given the spending on global expansion, all the new battery swap stations, and developing 2 new brands at once.
Right, if they're burning, maybe 1.2 to 1.5 billion a quarter on all that, suddenly that 5.9 billion is only a year-long safety buffer, maybe 15 months.
Precisely. And giving that context transforms the number from a static data point into a validated strength with a defined time horizon. It tells the reader they have a good runway, but the execution on those new brands has to be aggressive.
Okay, that feels like a really comprehensive way to shore up the risk profile. So now that we've stress tested the floor, let's pivot to the second pillar of the thesis, the valuation.
Right. The sheer scale of the discount that's being alleged here.
Yeah, so our second critique really focuses on how that core valuation argument is established and, more importantly, proven externally.
The report's thesis rests on this premise of a massive discount, that the stock is basically too cheap to ignore.
While the price-to-sales ratio is highlighted correctly as being suppressed at 1.3x, strengthening the context with some direct competitive benchmarking would make that massive discount claim undeniable. Right now, it's just asserted.
And the problem is the valuation disconnect pillar compares that 1.3x PS ratio only against NIO's own historical averages.
It's entirely internal, which, for high-growth EV stocks, PS is crucial because it's measuring value against revenue when margins are still fluctuating. But comparing it internally, it just doesn't tell you much.
It doesn't. If every EV maker's PS ratio is down right now, then NIO's 1.3 might just be the new normal, and that whole massive discount story just kind of falls apart. It leaves the central argument subjective.
So the suggestion is to anchor it to something external.
Pairing the PS ratio and the $13.5 billion enterprise value against, say, 2 or 3 direct competitors in the same space. That's the only way to prove the market is mispricing this specific company relative to its peers.
So practically speaking, what does the analyst do?
They should include a simple comparative table or a chart. Show the PS ratios for major competitors, like the closest peers in the Chinese premium EV space. If the peer average is, say, 2.5x and NIO is at 1.3x, well, that gap is your undeniable discount.
That reframes the whole argument. It moves from NIO is cheap compared to when it was less efficient to NIO is radically cheap compared to its current competition.
Yes, and let's look at the enterprise value. The report mentions the cash reserve, but the enterprise value itself needs that same context.
Because enterprise value, or EV, it factors in cash and debt. A peer company might have a higher market cap, but way less cash.
So the analyst should show how NIO's EV, which already reflects that big cash pile, contrasts with the EVs of its peers, especially when you weigh it against their projected revenue growth.
That would make the argument about financial efficiency and balance sheet strength so much sharper.
For sure. If a competitor has a higher EV but slower growth, the case for NIO at $5 becomes so much stronger. You're buying better growth and a safer balance sheet at a discount.
And what about the historical averages? Should we just get rid of that section?
No, don't scrap it. Just make it more informative. Instead of vaguely saying it's at a discount to historical averages, specify which periods. Was it during the 2021 bubble when everything was trading at 10x sales?
Right.
Then you have to articulate why the company is fundamentally superior now with the higher margins and delivery acceleration than it was during those inflated times.
Specificity equals credibility. Okay, that really strengthens the valuation case. Let's move to our third and final critique, which is really about the packaging for all this great data.
This is all about making sure the presentation matches the quality of the analysis itself.
The topic sentence here would be, to maximize the document's professional authority and perceived rigor, refining the urgent and informal language would better align the tone with the impressive quantitative data presented.
The data in here is profound. The Q4 projections, the technical floor at $5, the margin expansion. These are serious numbers that need a serious, objective delivery.
But the material uses a lot of highly effective promotional language. We see phrases like ultimate buy zone, too cheap to ignore, and the classic hockey stick growth curve.
And it even has non-analytical stuff in the conclusion, like a call to smash that like button.
Right.
And honestly, when you put serious financial due diligence next to a phrase like smash that like button, one of them instantly undermines the other. That urgent style, it cheapens the gravity of the data. It can make the whole thing feel more like promotional content for a casual investor than a serious assessment for a professional audience.
The data itself should be doing the screaming. The analyst shouldn't have to.
Precisely. So the suggestion is to shift away from that promotional language and towards more objective, financially specific framing. Let the numbers drive the conviction.
So we're talking about replacing the hyperbole with professional terminology.
Exactly. Start by swapping out those highly charged phrases. Instead of ultimate buy zone,
Which sounds a bit salesy.
it does. Use objective technical terms like critical accumulation range or key support level. It makes the same point but with a lot more authority.
And we also saw some pretty absolute statements about market sentiment. I think the phrasing was, the bearish narrative is dead when you look at the raw numbers.
That's a perfect one to refine. Instead of a declaration, make an observation. Something like, recent delivery acceleration challenges the prevailing bearish narrative, confirming a divergence between price and fundamental performance.
It makes the same point that the bears are wrong, but it uses objective language rooted in the analysis. It preserves the bullish thesis, but elevates the communication.
Absolutely. And then finally, the conclusion. When discussing the technical setup, the resistance levels at 560 and 650, that whole section needs to use strictly objective financial terms.
The conclusion should just summarize the risk-to-reward ratio and the technical facts. No calls to action.
The facts should stand on their own as the justification for the thesis. By removing that informal layer, the analyst boosts the perception that this is a professional, unbiased assessment which helps maximize the impact of the incredible data they've compiled.
Okay, that brings us to the summary. Overall, this analysis is built on a really strong data foundation, but the goal here is to elevate it from a convincing piece of content to a highly robust piece of financial analysis.
We covered three main areas. First, enhancing the analysis by incorporating counterarguments and stress testing that $5 thesis with a dedicated risk and mitigation section.
A section that really quantifies things like potential guidance misses and the actual cash burn rate.
Second, solidifying the valuation thesis by using external competitive benchmarking. Compare that 1.3x PS ratio against direct peers, not just its own history.
And third, calibrating the tone, matching the language to the analytical depth by replacing that urgent promotional language with objective financial terminology.
The key actionable suggestions are clear. Integrate that risk and mitigation section, use specific PS ratios for comparison, and swap out phrases like ultimate buy zone for terms like critical accumulation range.